Well, it will be a busy week for investors on the trade and energy fronts. Joining us right now to talk about it is Stephanie Link. She's chief investment strategist at Hightower, also a CNBC contributor. And Steph, first of all, good morning. Great to see you.
Good morning.
Think the reason that the markets, thank you, the reason the markets keep moving higher is because it's TGIF. It's Monday today. You want to explain that?
Yeah, so we are getting through some of the unknowns, some of the concerns that we had back in April. So TGIF is we're getting through trade. We still have a lot of questions, but we're getting through it. The geopolitics certainly is calming down. Inflation is coming down. I know it's not where the Fed wants it to be, but it is coming down. And the Fed, well, we don't know exactly when they're going to cut rates, but we're getting closer to that point. It sounds like they might go in September, and if they don't, that's okay too. It'll come later in the fall, but that's another unknown that we're getting through.
The Friday jobs numbers were better than expected. That's a reason that the markets were higher. I guess it's good news in that when the Fed does cut, you think it's going to be for the idea that they can because inflation's come down and not that they have to because the economy's cratering?
Yeah, I mean, right now we're running at about 2.5% in GDP, Becky. And you mentioned the labor market, the non-farm payroll numbers last week, but you also had better jolts and the weekly jobless claims numbers. That's something that I've been watching very carefully because we have seen it inch higher, but I actually came back down a bit last week as well. So the labor market is still really very firm. The ISMs, PMIs, manufacturing, they're still in contraction, but they are slowly recovering. And I think the biggest tell about the growth in not only in the U.S. but around the world is that copper prices are up 25% on the year. So that's very healthy. So overall, we're doing okay. That also bodes well for earnings. And I think earnings are going to surprise. Right now, people are expecting about 5-6% in terms of earnings growth for this quarter. I actually think you're going to see double digits. And I think you're going to see margin expansion as well.
So there are some people who have been waiting to get back in. I think you mentioned there's still a lot of cash on the sidelines, but you've been buying even at higher levels for some of the housing and financials. And I guess last week you added to D.R. Horton, you added to Wells Fargo and Truist Financial.
Yeah, I mean, I think that there's real value in housing. I know it's very depressed, but the numbers have been coming down, and I think that the expectations are so low. And I think now the numbers are finally at a point where, in terms of housing, where they actually might even beat expectations. D.R. Horton, it's trading at 11.5 times earnings. And so to me, if we get the Fed to cut, I think the housing stocks are going to take off. So I want to be ahead of that. And then Wells Fargo and Truist, I thought that they did really well in terms of the stress tests overall. And I think the financials in general are very attractive because they trade at like 1.5 times book. They're buying back stock. The stress tests we talked about have been better than expected, so they're going to be able to return capital to shareholders, more of it. I mean, Wells Fargo has a $40 billion buyback. They're going to buy back 15% of their market cap. And Truist is going to buy 6% of their market cap back. So I think you want to be buying with them. And and the banks, I think, are still really great in terms of values.